Welcome, everyone. Thanks a lot for joining in this special session of a FinAdvisor learning session. Today, we are going to discuss about building your investment portfolio with the help of exchange-traded funds, also called as ETFs. I'll thank everyone for joining in today. But before we start, we'll have a look at the disclosures. All information that we are discussing here or in our blogs or website are for education and entertainment purposes only. They are not intended as a substitute for professional, financial, legal, or tax advice. We are not finance professionals nor we are financial advisors as such. Before making any financial decision, you should read the product disclosure statement and if necessary, consult a licensed financial professional. Any information or advice on this site is general in nature and does not take into consideration your objectives, financial situation, or needs. For more disclosures, you can visit our website, www.finadvisor.com.au. I hope you can all hear me. So I'll get started. In case you are not able to, hear anything, let me know. And also, please let your questions coming if you have any specific questions, and then we can answer them at the Q&A session later on after we finish the presentation. Okay, so today we are going to discuss about what are exchange-traded funds or ETFs. How do they work? What are the different types of exchange-traded funds or ETFs? What are some of the pros and cons, advantages and disadvantages? Maybe you can say there are always a certain aspects of the investment we need to look into, and then how can we get started? What are the ways we can get into investment in ETFs? Also, we'll then discuss about some specific ETFs as to how they have been doing over the last few years. So exchange-traded funds or ETFs were first developed mainly in the US as such in the 1990s to provide access to passive indexed funds to individual investors. So this is kind of creating a shortcut for investors without analyzing each individual stock and giving a diversified portfolio to the investors, basically based on the indexes that are being defined by, let's say, S&P or some other global organizations, financial institutions. Based on them, the exchange-traded funds were created to help investors basically mirror the index in the form of their investments. It's a kind of an investment fund, so it's just like another company. They issue their units or shares, and those shares, the typical, the criteria, or you can say the distinctive criteria, is that those shares are listed in a stock exchange. That's why they are called exchange-traded funds. They're more or less to some extent maybe like mutual funds as well, but mutual funds are usually not traded in exchanges. You have to subscribe to them separately through their website or your financial advisor or any other channel as such. Exchange-traded funds hold assets such as stocks, bonds, currencies, and or commodities. There can be other kind of assets like just maybe based on the futures, or they are called more or less synthetic ETFs. So sometimes they don't really invest in a particular in the basket of shares. They're sometimes based on derivatives or maybe futures options as well. Most exchange-traded funds are based on index as of now, like how they are being prevalent across the globe. So either not only the top index like S&P 500, or in Australia maybe ASX based index like XJ or something, but it is they usually follow a particular index. Maybe it is based on a particular sector or a type of stock or something like that. Exchange-traded funds are similar in any way to mutual funds, as we discussed earlier. But the biggest difference is that the exchange traded funds are, listed in a stock exchange. Also, in terms of other aspects of differentiation with the mutual funds, is that exchange traded funds um, do not have any entry fee or exit fee as such. They do have some management fees, and that management fee is usually very low in comparison to the management fees being charged by the mutual funds. Also, there are no minimum investments. So just like the shares, you can get started with maybe say $100 or something like that. You can get into exchange traded funds just like shares. So of course, there will be brokerages, charges in the when you are buying them or selling them. But as such, there is no entry fee or exit fee, nor there are any minimum investment criterion as such. But in case of mutual fund, sometimes you have to um, contribute at least maybe say $5,000 or $10,000, depending upon which country it is. It is maybe in Australia, I have seen some of the funds, they ask for $10,000, or in certain cases, maybe $100,000 as well, depending upon what kind of mutual fund it is. But in case of exchange traded funds, there is no minimum investment required as such. An exchange traded fund divides the ownership of or all its assets into shares that are held by the unit holders or the shareholders. So they are just like they are another company. All their assets are being distributed over the number of shares. The only difference with a company, like say in Australia, there is a concept of a listed investment company, where the company invest in other companies, or other listed entities, or maybe some businesses, and that particular company is a listed company, so that is, they are called listed investment companies. The difference between those listed investment companies and the exchange traded funds, once again, are that listed investment companies have a specific amount of authorized capital or paid up capital. So they cannot raise funds whenever they want, or they cannot increase their capital as such. But exchange traded fund are free or open ended in that way, that the more people buy their shares, they can straight away deploy that fund into different their assets. So they do not need to get another approval from the exchange authorities, or maybe ASIC as such in Australia, in order to increase their share capital as such. So that's a major differentiation factor of ETF. That's why they are so popular in in the people's mind, and they are so you can say easily available nowadays. The shareholders directly own the assets of the fund, and they get annual reports as well. So the funds issues normally, of course, one annual report, and also sometimes monthly report or quarterly report, where they explain about their investments, how that is going on, and what are their holdings, what is their strategy, and things like that. Exchange traded funds are very attractive because of their low cost, sometimes tax efficiency. They are easy to calculate. Like there are not like trusts in Australia, where the calculation of income tax is a bit complicated. This is just like shares. So whatever the rules are involved for the shares is the same thing that applies to ETFs as well. And some of the ETFs actually pass on the franking credit as well, which is very useful for investors in Australia. Okay, how do they work? So basically, an ETF is a managed fund, but the differentiation is that the investors can buy and sell on an exchange, like say Australian Stock Exchange in Australia. And most in Australia, most of the ETFs are passive investments. They don't actually try to outperform the market. This is a clear distinction from the other exchange traded funds in like the countries like the US. In the US nowadays, you can say a majority of the funds are actually managed funds. So they they specialized on a particular sector of investment. It could be a particular technology, it could be a particular sector, it could be a particular based on a certain criteria. Although the most you can say may not be the profitable, but the most popular ETFs are still based on the indexes, like say S&P 500 or something like that, maybe NASDAQ or something like that. So in Australia, most of the ETFs are passive based on indexes, like say ASX 200 or S&P 500. There's one particular ETF based on the NASDAQ as well, and we'll look into that. The role of the fund manager is only to mirror the index composition. So his job is to invest the amount in the assets in the particular shares in the same proportion or in the same ratio as they are part of the index as such. Let's say, ASX 200 or something like that. Or maybe they are sometimes based on a particular commodity, like say gold. So nowadays, these ETFs are very popular, especially in India as well, where people do want to buy gold, but they do not want to have the physical, I can say, custody of those. So they are very popular in terms of the people can buy the exchange traded fund or the shares in the exchange traded fund, and the company actually invests in gold physically, or maybe in terms of a documentation as such. They own the physical gold or the document for the gold representing that physical ownership, and that becomes very easy for the investors. The value of the ETF, because they are sometimes based on the index, or so they vary along with the index very, you can say, proportionately. They in the same ratio or in the same proportion. Of course, there are other types of exchange traded funds. We'll discuss about that. Thank you. Someone gave me a feedback that my voice is a bit breaking sometimes. Okay, I'll fix that. Okay, now in terms of types of ETFs, there can be two types. Maybe one is, as I discussed, if it's physically based, exchange traded fund, which are based on the actual, let's say, securities or particular assets, like say gold or other commodities. So they are physically backed, and there is a particular audit happens to their investments, and investors can be assured that if their investment is backed by certain their particular assets, and the value of the ETF is derived from the net asset value of those investments, so those underlying assets. So it is much more, you can say, reliable kind of investment as such, rather than other companies who are maybe investing in a particular theme or something. But there can be some synthetic exchange traded fund as well, where they hold some of the underlying asset, but they also use instruments like futures and options and other types of derivatives, which give them maybe additional advantage to the investors in terms of you can call it leverage. So based on that, they can they follow that particular derivative as such, and it is clearly mentioned in the document, in the product disclosure statement, that the company is going to invest in that manner, that they will invest in that underlying derivative or something like that. When the investor invests in an ETF, he doesn't own the underlying investment. So it is owned by that asset management company, that the fund manager, but he owns the units, and they are being properly monitored, regularly audited. So there is a lot of security in those terms. Okay. If you have got any questions, please you can message me in the chat window. I'll keep on watching it. If it is possible, I'll try to answer them at the end of this session. Otherwise, maybe I'll send you an answer later on when we finish, and by email. Okay. What investors can invest through an ETF is in a range of asset classes. So that is another factor which has given popularity in terms of those ETFs. Like say, you can invest in domestic Australian shares. Those companies, the ETFs, can invest in international shares, a particular sector of the Australian or international share market. Maybe like say mining, financials. Nowadays, in the US, there is a specific ETF which has got approval to invest in cryptocurrencies as well. There can be investments in fixed income investments, maybe bonds or something, precious metals. There is one particular ETF I was checking, which is based on palladium. So which is doing pretty good actually. It has increased quite a few, by a significant percentage in the last 5 years. I was looking at the performance. Also, the ETFs can be based on foreign currencies as well. There's a question at what's the difference between ETF and index fund. So there can be different types of ETFs, and some of them are index based ETFs. So index funds are specifically ETFs which are based on an index, but there can be other ETFs other than index based as well. Okay. But there are certain type of funds or instruments which are not really an ETF, but people sometimes may think that they can be. They can be like exchange traded commodities, exchange traded notes, certificates, securities. There are in Australia there are things called warrants and many other things like that. There are some even managed funds which are exchange traded, and maybe some hedge funds as well, but they have got limited applicability. They are not really exchange traded funds. What we are discussing about ETF here, they are purely based on particular fund which deploys all its investments into a particular segment of assets, a segment of shares, or a particular sector of shares, or maybe some commodities, and they're specifically mentioned like that. Okay, so now why they are so popular nowadays? Sure, there's a question. I'll come to that later on. Why they are so popular, the exchange traded funds, and why it is a good diversification in terms of your portfolio. So I could not obviously mention all the points in the PowerPoint, but definitely I'll try to discuss some of them. So one of the major factors is the diversification. ETFs allow investors to invest in a basket of shares. Like say, if you would like to invest all the 200 shares of, you can say, which constitute the XJO or the ASX 200 index, it is not possible for an individual investor to do so, because some of the shares can be very costly. Some of the shares, they have to be buy in certain quantity, and then there would be brokerage charges on all the shares that you purchase. So it is practically not possible, or you can say feasible, for individual investors to buy all the shares. That again, there is a particular composition in a particular index of the shares. So if an individual investor want to follow that may not be possible, because those practically the value of the individual shares might vary, and that will change with the composition. So if someone wants to follow the index, and he wants to diversify his investment into all the shares of a particular category or sector or a market or an index, then ETF gives them that opportunity. Also, because they are diversified, they are invested in so many companies. The movement or the risk factor, maybe you can say a little bit less, because they are diversified across 100 200 companies. ETFs also allow investors to invest in markets or assets that can be difficult or expensive to access. Suppose today you are in Australia and you would like to invest in, let's say, in a country like, say, China, or maybe, let's say, in India, then there is no direct opportunity to invest. There are opportunities, of course. There are nowadays a lot of broker houses available, but they are not accessible to all the investors. And sometimes we do not have the specific knowledge about the market, that which companies are performing well, and what is their outlook in the market, and what is their prospect in going forward. So there is not enough time for us to research and investigate all those. But if we'd like to, let's say, invest in let's say, specifically to a global perspective, like, say, we want to invest in India, we want to invest in emerging countries. So there are specific exchange traded funds who are dedicated for investment in those countries or those markets. So that is a very easy way to diversify as well, into your investments. Um, in Australia, there is another concept of a self-managed super fund. So when you are investing through self-managed super fund, you are not allowed to open, specific kind of overseas accounts or something, which may be very difficult, in terms of regulation and all that, and in terms of their audit requirements. But one way is to invest using ETFs, through the self-managed super fund, where without violating any rules or any regulation, you can actually invest in global shares or global markets. In terms of transparency, ETFs are very popular that they publish their net asset value mostly on a daily basis on the stock exchange, and also in their website. So people can actually compare the price they have paid for each individual share with the net asset value. In case of shares, there is no really direct relationship between the price that is being paid for a share or the inherent value of the shares. But in case of ETFs, they are actually being representative of the net asset value of the fund. So people get more confidence in that particular investment, that at least my fund is my investment is specifically deployed in a particular ratio in those assets. Most of the ETFs, because they follow the index or because they follow a specific formula to invest, their management expense ratio or the management cost is very low. The expectation is that they follow the composition of an index, or a particular index representing a particular sector, or maybe global markets. So they just have to follow that formula, and using that formula nowadays, using softwares and systems, they can allocate their assets or their funds very easily within split of a second, and they can place their orders accordingly. In case of managed funds or mutual funds, they actually put their expertise in selecting specific stocks, and that too in specific ratio, or you can say specific composition. So that's why they charge more fees. That's why they sometimes also charge some performance fees, the performance based fees they have, and they also charge you can say entry fee, exit fee, and a lot of other kinds of fees. As I mentioned, ETFs are very easy to trade. They can be bought and sold using normal brokerage houses. So if you have got an account with Comsec or E-Trade or those platforms, you can easily buy the exchange traded funds. There are a lot of other ways to buy the exchange traded funds, and we'll discuss about them later today as well. The next, you can say, if you see in terms of the disadvantages, or you can say the cons of investing in ETFs, is that they sometimes directly represent the index. So they don't really are based on the underlying value of a particular share or something like that. They are diversified, true, but they are if the index itself loses value, or it falls in the market value, then accordingly the ETF will also lose value, because ETFs are just representative of the index. Some of the global ETFs which invest in international assets, they have the risk of the currency movement. But nowadays there are ETFs which are currency hedged as well. So yes, there is a risk, but now there are funds which mitigate that risk as well. Some ETFs invest in shares that are not so much liquid, or sometimes they invest in particular assets which are not so maybe liquid. And sometimes the ETFs become they themselves become illiquid, like there are not many investments, so their asset allocation is not really on a real time basis. So those are the kind of some issues there. In general, ETFs are very reliable or maybe popular, because they provide direct access to the market, and they have very low cost. So there are cons, but they're probably limited to certain areas. Now, how to buy the ETFs? So that's interesting, and that is been evolving something on a day-to-day basis. Of course, there are traditional brokerage houses, like say I mentioned ComSec, E-Trade, other brokerage houses, through which you can buy an ETF through the through a stockbroker, buy and sell the units of the ETF. So just like shares, sometimes if you buy through those brokerage houses, you get their it can kind of those custodian backed numbers, so that it goes to your HIN number and all that stuff. Of course, you have to pay the brokerage on the you can say the ETF that you are buying, or that based on that transaction value. But there are other ways to invest in ETFs as well. I have not mentioned probably specifically in the presentation, but there are nowadays a lot of mobile apps, or um, cloud-based systems, where websites where you can buy the exchange-traded funds or ETFs, or units of a ETF in a particular ratio, or maybe selected categories of ETFs, using those mobile apps and all that. So there are a number of apps, like, so there is in Australia there is one app called Raise, where if you invest the money, they actually distribute into 7 or 8 exchange traded funds based on your portfolio orientation. So that's another app, and there are multiple other ways as well. There are certain specific apps, like say someone mentioned Superhero. Yes, that's right. And then there are apps like provided by the brokerage houses, which are specifically tailored for the self-managed super fund, because self-managed super funds investment is a bit tricky, and there are a lot of regulations. So they have created specific mechanism to invest in those you can say ETFs, using those. Now, the biggest advantage of the ETFs is that you can actually compare the price and the price of the share or the fund and the net asset value. So that gives you confidence. You can go through the ASX website to check the NAV, or you can go through the the funds website, where they mention the NAV on a regular basis, or mostly on a daily basis. The price the investors can buy and sell an ETF is very close to the NAV. But there are certain things that you should be probably aware of. If you would like to follow like that particular day's NAV, in which day you are investing, then you need to invest in a particular time of the day. Like if you invest in Australia early in the morning, then you will get a more closer price to the net asset value. So something like that, there's a concept of that, the number of units that you get, especially if it is part of the trade. So, to get a best price of the ETF, trade closer to the NAV, it has to, like, if you just place your order 30 minutes before the market opens, or just maybe when the market has opened, you can get the probably the best price. Also, it is better to buy or sell the ETFs when the market is open, or just is going to open. So then you can get the best the best price, you can say, the best value closer to the NAV. Okay. Of course, we are not doing any recommendations of any particular ETF here. So always look into, read the product disclosure statements, or the related documentation. It's better to visit their website and get the detailed information. Now, based on the publicly available information with ASX or other tools, I have just compiled some of the ETFs. These are not recommendations. I'm not saying that these you should go and buy all these ETFs. It is just to understand how how is this performance of some of the ETFs in Australia. I've just grabbed a few names, and based on my own analysis and understanding. But of course, these are very dynamic things. The things keep on changing on a regular basis. But let's say this particular ETF, which is based on S&P 500, but it's in Australian dollars, so you can actually follow the US market there in the Australian dollar. So if you see that 5 years ago, that price of that particular ETF fund or unit was $273. Now current price is $422. Last year, actually, they gave a dividend of $91 on each of those units. So that is at that time the price of the fund or the unit was around 520 or something like that. I'll show you in the chart. I have got that one. Similarly, there is a fund called iShares, and it's based on the, or it is created by the company called BlackRock. So it's iShares BlackRock. So they have created all these funds. So Global 100, the 5 years ago the price was 99, and the current price is 131, and the dividend is $24 in the last 1 year. There are World All Cap. The same way, 5 years ago, the price was 26, current price is 41, and the dividend is $6.15. So these are some of the, you can say, good, best performing ETFs in Australia this year. Just to understand how do they work, if you look at this S&P 500 ETF, which is, the code is IHVV. So these basically they invest in all these securities, like which are components of the S&P 500, like say Apple, Microsoft, Amazon, Alphabet, which is Google, and then Facebook, Tesla, Berkshire, and all these companies. So their asset is $4.9 billion. And if you look into their weightage in these top 10 shares, it's around 28%. So this is I just tried to see how they have performed in terms of the charting by looking at their prices in the chart. You see the highest price, this particular S&P 500 based fund was 515, and they announced their dividend, and then their price actually fell from there. Of course, the one particular characteristic of the ETF is whenever they pay out the dividend, that price of the unit is directly reduced by that amount of the dividend, because of course the net asset value is closely closely followed by the price. So it is the price is actually based on the net asset value. So as soon as the dividend is paid out, that value goes away from the fund. So obviously the price reduces. So in this case also, but even after that, if you see the growth in the price is almost 77% over 5 years. So that's a tremendous value. Well, whereas if you compare that with XTO was only 44%. Now, and this chart is over 5 years, you can say. Now, this is another one, the Global 100 units. So that particular share has gone to 50%, or the ETF has gone up by 50%. The XTO was 44%. And again, this fund also announced their dividend there. So these are some of the funds I have taken screenshots from the charting software, just to give you an idea how they have performed over last 5 years. And you can actually, using the charting tool, you can also see their dividends, how frequently they have been paying. So that gives you some kind of confidence that they're about their performance and their underlying asset growth. So this is something basically I was talking about, the palladium based ETF. You can see it has grown up by 176%. Actually, it was much more at a particular point of time last year, before the COVID. I think after the COVID has hit, it was reduced significantly. But the highest price, it went up to 429, and the price was just maybe low, less than 100, 5 years back. So this is another fund, iShares BlackRock Global Healthcare Fund, which invests in the pharmaceutical companies or the companies related to healthcare. So if you would like to monitor them, you can do that as well. So this is an example of how there are ETFs based on this particular fund is investing in a particular sector. So if you are interested in that particular sector, then you can buy that fund. Similarly, there is one international, quality companies. So here you can see mostly the US-based companies, but there are certain other companies based in other countries as well. Like say this one is, I think, based on Netherlands, ASML Holdings, something like that. There are investments in other countries as well. And in case of international, they follow the international index as well. This one is a small cap, S&P Small-Cap index-based ETF, and they have got all these holdings. There are some questions we have received. I'll just quickly try to respond to them. If you have any other question. So would a synthetic gold ETF be more volatile or risky than physical version? Yes, that is right. I specifically do remember there is one US-based ETF which is called JNUG, JNUG. That is very volatile, and that they have actually invested in specific gold assets. They don't exactly invest in the gold as a like physical gold as such, but they invest in gold futures and the companies which are mining gold, things like that. So that particular JNUG company or the fund is very volatile. Whereas if you just follow the gold ETF in Australia, then that is not so much volatile. That is more stable. There are other platforms like Superhero and all that. But Superhero has got, I think it is mainly promoted by Beta Shares, and that ETF is mostly only for Beta Shares ETF. They don't have any brokerage as such. But other shares and all that, they have got a small brokerage fee. Answer this: does all ETFs pay dividends? Okay, no, not all ETFs pay dividends. So that is a good question. There are some ETFs, they don't pay a dividend at all. They just increase their value over time. But they are quite well as well. Let me just find out one example. Maybe I'll try to grab one which is good, but they in terms of value they are pretty good, but they don't pay any dividend as such.